Dear students, as discussed in the introductory video, I told you that in this week we will take some case studies. First, we will take the MAT provision, a problem on MAT provision. And in theoretical module, you have learned that every company has to prepare or calculate two types of tax liability. One is tax liability under normal provision and tax liability under MAT provision, that is minimum alternate tax. Every company has to calculate the tax liability under normal provision and under MAT provision. Here I have given some items for a company. The profit and loss has been given to you and certain items have been debited and certain items have been credited. So, you have to calculate the taxable income first and then you have to apply the tax rate to calculate the tax liability under both normal provision and under MAT provision. Let us take the example. Suppose we have considered the information of Fruit-Relay Company for the year ended 31st March 2018. The net profit is given as per statement of profit and loss like 25,40,000 and certain items which have been debited to statement of profit and loss account is the income tax, proposed dividend, depreciation, deferred tax liability, fine paid to customs authority, provision for an unascertained liability, Securities Transaction Act tax and dividend distribution tax. So, these items have been debited to the statement of profit and loss. And certain items like amount withdrawn from general reserve, profit on sale of long term equity and shares after payment of security transaction tax. So, these items have been credited to the statement of profit and loss. And there are certain other information also. What are the other information? The depreciation has been given. The depreciation as per IT rules, the company has a certain brought forward losses and unabsorbed depreciation. There are two types of balances for accounting purpose and for tax purpose, which will appear in the screen. You can see I am not discussing the amount. And next one, the tax credit brought forward under section 115JAA. Certain amount has been given there and you have to apply the normal tax rate as per Income Tax Act. Let us solve the problem first. So, as per provision of the Income Tax Act, you have to calculate the total income as per normal provision and the book profit as per MAT provision. So, you have to consider the items which have been debited and which have been credited. So, first we will calculate the taxable income under normal provision. What will be the effect? Let us see. So, prepare the column and starting point is the net profit as per schedule 3 of the Companies Act, that is net profit as per statement of profit and loss rupees 25,40,000. This is the starting point. Then you have to add income tax 1 lakh, proposed dividend 75,000, depreciation 3,65,000, deferred tax liability 35,000, dividend distribution tax 22,000 and provision for unascertained liability 55,000. So, you have to add all these things to the net profit and then you have to deduct the amount which have been credited to the statement of profit for the calculation of total income as per normal provision, like withdrawn from general reserve rupees 56,000 and depreciation rupees 2,45,000. Long term capital gain 1,50,000, brought forward business loss 2,50,000 and unabsorbed depreciation 3 lakhs. So, all items to be deducted and the total income comes 21,91,000, something like that. So, this is the total income as per normal provision, and the second part is the computation of book profit. So, in case of book profit, the starting point is also the net profit as per schedule 3, that is net profit as per statement of profit and loss. So, the starting point is the net profit, that is 25,40,000, then income tax, proposed dividend, depreciation is coming, it will be treated separately, deferred tax liability will be added, dividend distribution tax would also be added, then penalty paid to customs authority. Mind it, in case of computation of total income, we did not consider, because it is a normal expenditure for computation of total income as per normal provision, but in case of book profit, it would be added back. And then securities transaction tax, it would also be added back, and provision for unascertain liability we have considered in case of computation of normal provision, but in case of calculation of book profit, it will not be considered. And then again you have to deduct certain items like withdrawn from general reserve, depreciation. Mind it, the depreciation which is arising out of revaluation, that should be deducted, that should not be considered. That is why we have deducted the revaluation assets, we have deducted. Then long term capital gain, brought forward loss, it should be considered carefully. Long term capital gain would not be considered here. Then you have to consider the brought forward loss and unabsorbed depreciation, and as per rules, as per provision, the brought forward loss or unabsorbed depreciation, whichever is less, to be deducted in case of calculation of book profit. But in case of calculation of taxable income under normal provision, we have considered both the item, brought forward business loss and unabsorbed depreciation. But in case of calculation of book profit, only the unabsorbed depreciation or brought forward loss, whichever is less, will be deducted. Now, you got the book profit as per MAT provision. Now, you may apply the tax rate. In case of normal provision, it is 30.9%, that is the cess has been considered here, and it marks as X, and as per book profit, you have to consider the tax rate at 18.5%, and you have to include that cess. So, it comes 19.055%. So, it is marked as Y. What the provision says, as per provision of the Income Tax Act, the company is liable to pay the higher of the tax liability computed under normal provision and the tax liability under MAT provision. So, here it is marked as X, the normal tax liability, and Y is marked as the tax liability under MAT provision. So, whichever is higher. Here, as per calculation, the company is liable to pay the amount as marked as X, because it is higher than that of Y. So, this is the tax liability of the company. Now, you have to deduct the brought forward tax credit, MAT tax credit under section 115JAA. So, after deducting this amount, you will get the tax liability. Now, what would be the amount of carried forward MAT credit under section 115JAA? The amount would be nil, because the entire amount which was carried forward under section 115JAA has been deducted from the tax liability. So, after deduction, the amount would be the tax liability of the company, and there would be no balance in the MAT credit to be carried forward. So, this is the provision. So, you have to calculate both the tax liability under normal provision and under MAT provision, and as per provision of the Income Tax Act, the company is liable to pay the higher of the amount. Here, in this case, the company is liable to pay the tax liability under normal provision, and the amount which was carried forward from the previous year under section 115JAA to be deducted. So, this is the example of MAT provision you may easily calculate the tax liability by applying the provisions. Thank you.